Good evening, everybody, and welcome to the Middle Class Investor. This is Seth Martin, and it is Friday, the 26th of July. So July is almost over with, and it's about 10:30 in the evening, and we're looking as we always do. Well, not exactly actually. What I've got up is the SPY. So let me put the S&P 500 up. I was just looking at the SPY. So here's the S&P 500, and you can see we're right in the in this area where I had kind of drawn. I guess it covers 2 weeks. We talked about it last week how we're kind of got to that line and started to roll over, and now we're retesting that line. Actually got a little higher, so we got I don't know, 3 weeks in a row we made new highs. So this is a closing high. So here's actually 3 out of the 4 weeks we made closing highs. So closing high, and closing high today. So we're just watching this carefully. We should see some sort of, like this and then down here. Unless this is just all wrong, which it could be. But the pattern looks pretty good. And I don't think there's any reason to abandon it just yet. And so I'm sticking with it. Plus, we're getting kind of. We're pretty good ways away from these moving averages, like the 50-day, or in this case, the 50-week, and the 30-week moving average. If we go to a daily chart real quick, you can see the 50-day is here in blue, and we're pretty good ways away from it. And that's usually, once this gets a little stretched, tends to bounce back the other direction. So, kind of like, you can look all along in here. You can see, well, it got really stretched here, but here it started to stretch away from the 50-day and came down to it, stretched away from the 50-day, almost came down to it, came down through it this time, pretty good ways through it, to the 200-day. The 200-day was support here, and then it rallied back through and has been rallying ever since. So, like I said, there's resistance here, not only just trend line resistance with this pattern, but also pivot resistance off this pivot right here, which was the previous high. So we kind of created a little decision point area there, and we've got a decision point resistance or a pivot resistance. If you see here, there's a pivot right there. This was the last swing high. It was also the last swing from the low. So it was the last high from the previous low is right here. So what you do is you take a whoops, get rid of that. You take a decision point, or you make a box there, and it's just arbitrary. And we're right there. So I think this is a great area to be a little cautious. Of course, now it's been that way now 3 weeks in a row, right? Last week it looked like that was going to be the week, but this week we rallied to a new recovery high, and so that's where we stand. All right, and again, this could all be wrong, okay? But we're expecting this pattern to play out with a wave 4 ending down here somewhere. I've got that kind of drawn. You can see the E here, so it's A, B, C, D, E, 4. Okay, and then we would expect a 5 back up to this target area, probably around 3,400. It's not on the chart here, can't really see it. 3,500 on the S&P 500, and then that should be the end. Let's just pull it up and show you, which is pretty scary looking, I guess. Let me do log. So we're going back here to the 1929 low, where this move up here to the 37, I think it was 37 high, was a wave 1. This is wave, you can kind of see it here, A, B, C, 2. And then this is 3. All this is 3. So you got a 1, 2, 3, 4, 5 to end 3. And then we had 4 with an A, B, C into the 2009 low, which ended 4. And everything since 2009 has been trying to complete 5. But if you zoom in on 5, you can see here we've got kind of a 1, A, B, C, 2, 3, where this is all 4, and then 5, terminating somewhere up in here. So that's the I don't want to say forecast, but to me, if you're going to trade financial markets, you need to have some sort of plan, both a shorter term plan, an intermediate term plan, and a longer term plan. And the longer term plan, at least for me right now, is steering clear of equities because there's just a lot of risk here. One of the things you notice when the market goes down, it goes down much, much faster than it goes up. And it makes we've talked about this before, but the psychology of it makes it very difficult to make a decision when you're in the middle of it. You kind of self-talk yourself into sticking with it, and it should bounce. And the reality is, during bear markets, it just doesn't tend to do that. I mean, it's easy to look back on it now and go, oh yeah, I should have sold here, or I should have sold there. But the reality is, when you're in the middle of this, it's very difficult to make a decision. And so what I like to do is, I kind of like, let's just use an example. Let's talk about what I might do right here. What I might do right here, well, maybe I'm going to do nothing right here, but let's talk about, let's say if the market, let's say we get a candle next week that looks like it's just an inside week. In other words, it's inside this white candle. And then the week after that, we get a candle that looks like this. Okay? What I might do is wait till it rallies just a little bit and then buy some puts right here. Okay? Puts. Now, which puts would I buy? What do I do? Well, okay, we're looking for this to come all the way down in here to around 2200, right? So there's a couple ways you could do this. One, you could say, well, there's a pivot right here, so probably this is going to come down and stop and then rally and then fall. So what I could do is I could wait till it gets here to this area right in here. So wait till this comes down into here, okay, and then rallies back in some sort of ABC, and then buy some puts here, okay. Now I've got a lower high, and then what do? If you're wrong if it goes to here, let's say, okay. So that's one way to do it. You could also just buy puts here with a move into this area. So let's say that our target is 20. Let's say that we think the market will turn back around and start going up at around 2700. So maybe what we want to do is look at, okay, well, at 2800 or 280 on the S&P, okay, 280, that's the SPY. What would a 280 put cost me, given that it's going to have a $10, it's going to go from 280 to 270, okay, so it's going to have a $10 move. What does a 280 put cost, and then how much time should I buy here? Well, as far as time, you might look at 1, 2, 3, 4, 5, 6, 7, 8 weeks. You might look at 2 months' time. So that would put us out. Let's just go look, okay? So let's put in, let's go over here to trade. And let's put in SPY. So this is kind of a fun exercise. So we might even just do this. I might just do this. This particular account I'm on is a paper money account anyway. So Okay, so 2 months out, you always want to go 30 days plus whatever your target is. So if your target's 2 months out, then you want to go really 3 months out. Okay, so 3 months is about 84 days would be good. So let's increase the number of strikes here. Let's look at all. So we want to look at something around the 270. So here's 270. I'm going to look at open interest here so I can see how many contracts are being traded at these various prices. So here's 270. Notice we're not the only ones looking at these. I mean, you can look at the number of contracts here, and 20,000 is a lot, right? So there's other people looking at this 270 as well. But we could buy this out of the money option here for $1.40. So let's say you wanted to take no more than a $500 risk, okay? Well, you take $500. Let me type that in my trusty calculator. $500, and you would divide it. See this option here. I didn't want to do that. Let me leave. This option here is $1.40, which the way options work is they're always in one lot is 100 shares, so you multiply this by 100, so that'd be $140. So if you take 500 and divide it by $140, you get 3.5. You get 3.5 contracts. So if I bought, let's just say I bought this. Let's go with the mid. Here's the mid price. Let's say I bought, you can't buy a half a contract, so you just buy 3, and that way you're not risking more than $500, okay? And you go and you put this in, see it's $420 plus the cost of the option. And, you know, you get all these numbers like max profit and this kind of stuff, but that's if it went to 0, okay? So it won't, you know, we're pretty sure it's not going to go to 0. But here, we'll just go ahead and send that. But what is it? What is the plan? You know, what is it potentially could do? And let's just get up here on the screen and draw a little bit. So if let me go to a daily chart. It's always good to see your pivots and everything on a weekly chart. Like there's a really good pivot right here, and we're on a weekly chart, as you'll notice here. But when you actually go trade and you're looking at your targets, you want to divide that time frame by 5, which would be a daily. So let's just look at a day. Let's just pick a daily here, and let's zoom in on here. And let's say our target is right. I'm going to draw a line. Our target's just below this low here, okay? So let's say right about there, 269.80, basically 270, okay? And oh, I did that wrong. Okay, what I needed to buy, I'm sorry, was a 280. So let me go back to the trade tab. So a 280 is going to be a little bit more expensive, quite a bit more expensive. $225. So we're only going to be able to buy 2 of those contracts. So let me go back and cancel that order. Let's see here. Where am I? Let me scoot that over a little bit so I can get to it. Let's working orders. There's what I want. Let me cancel and replace that order with a 280 put. Change the number of contracts to 2. Unlock the price. There we go. Let's go to the mid, and we'll confirm and send that one. See, my risk is $450. Okay, let's go back to the chart. So my target's 270, but I'm going to buy the 280 put. Now puts, the way puts work is as the market goes down, the put becomes more and more valuable. Okay, so in other words, we're buying an out of the money put with the expectation that it's going to go down. Now it doesn't actually, let's say it goes 81 days or whatever that was, and it gets to here and turns around and starts going up. Well, we're not in the money, so we would probably need to go ahead and sell that put. But what we want to do is what we want to see the stock do, in this case the SPY, is you want to see it, kind of make its way down into this area, okay? And we're going to chop a little bit sideways like that and then do like that. And then what happens is, let's say right here, it hits the target and it starts to come, starts to come back. So right here, right at this line, this is where we begin to be in the money. So let's say that there's only 30 days till expiration right when we get right here, okay? That put's it's going to be worth quite a bit of money, and as it goes into here, okay, well, I'm sorry, let's say 40 days till expiration, we're right here, and then say another 10 days it gets down to here, and we sell it, okay, we sell it back. Let's talk about at expiration. At expiration, if the stock comes down to right here, this put has to be worth $10, okay? Because 280 minus 270 is $10. But then we've got $2.25 in cost, right? Because we had to pay $2.25 for it. What does that mean? That means we made $7.75 times 200 for the total number of shares. Okay, so we were controlling 200 shares. So with a $450 risk, you made $1,550. So 3 times your money. That's the kind of trade, I'd be looking to set up. Now what you could do, like I said, is you could just wait. A more conservative approach would be to just wait until this comes all the way down here and starts to bounce and come back up. And then maybe when it gets here, buy an out of the money put, and now you can play for a bigger move because it's not cooperating. Sorry. I don't know why this isn't cooperating, but it's not. Okay. There we go. Okay, so the bigger move is down to here. So we'd have to look at the price of options. But let's say this came down here and ran up to here, back up to, maybe filled this gap here to 290. Well, then you could buy, let's say, the 260 or the 250 even. And your target would be down here at 225. So 250 minus 225 is $25. Now maybe because it's further out of the money, maybe you only have to pay like 80 cents for it. And so with $500 worth of risk, you can risk more. But now instead of $2.25, you got an 80-cent risk. And not only do you have an 80-cent risk, but you've got a 25-cent target range, right? A $25. So your cost is 80 cents and your reward is $25. So 25 minus 80 cents, basically, $24. So let's say we're able to buy 5 contracts with a $24 gain. That's 500 times 24. That's $12,000. So you can see, if you have a good plan, you can make a good. Now these are low probability trades. They don't always work out, but they're not bad trades to take if you have some idea of what your pattern looks like. And of course we do. If this is correct, we do have an idea of what our pattern looks like. So I just wanted to give you a little example of how that might work. But let's go ahead and let's look at volatility index. Let's go back to weekly. Okay, so volatility is down this week, as you might expect, since the market was up. That's what we'd expect. So let's look at the 13-week Treasury. Let's get off that. Still very much below this this area that we were looking at. Still below that. Fed's probably going to lower some rates, especially now since this is curling over. But I think the Fed is really setting itself up for some disappointment, because if you look at the 10-year, this thing has maybe one more low in it, if at all. So I want to show you. I don't know if I can get this all on the screen, but what I'm looking at here is this pivot right here. There's a pivot right here. Of course, we're looking at this decision area right here. So let me zoom in where the current price action is, which is right here. So we're already in that decision area off this pivot, and I think it's very possible the 10-year makes another move down. It's already kind of started that way. It might rally up a little bit next week, and then over the next couple of weeks come into this area just above 1.9. I'd be surprised if it got much lower than 1.9 because of where this pivot is. So I would look for 1.9 to be about it of this move. And I think the Fed is going to be very, very surprised when this really starts to take out and the spread starting to widen between different bond instruments. And that widening creates a lot of, well, it's great for traders, but it's bad for banks and financial institutions, because it basically makes them afraid to loan, and then credit gets tight, and so on. So you know that story. Everybody knows that story. So anyway, so I still think there's a ton of risk in the bond market, and I wouldn't be surprised if this made one more low over the next 2 weeks or so, 2 or 3 weeks, and then just really rocket it out from there. All right, let's look at Germany. Germany looks a little stronger, although pulling back. Japan's still in this downtrend, really hasn't pulled out of it. The UK, they got some interesting things happening in the UK. I think people are going to be surprised. I think the UK is actually going to do a lot better. I think money flows are going to come into the UK. You got to remember, investors are pretty savvy. The media is talking about how horrible it's going to be if the UK separates from the EU. But the EU is has been very constraining to the UK. They've decimated their fishing business in the North Sea, made it illegal for the Brits to even fish their own waters off the North Sea. There's just all kinds of crazy stuff the EU has done. And I think what's going to happen is investors are going to see this for what it is, and money's going to flow into the UK, not out of. And I don't know. I just think it's going to be a surprise. It looks like we're setting up for a surprise, and so I wouldn't be surprised if we get it. Now it may come down to here first. The panic may set in. It may come down to here first, but then I don't know. I just got a feeling. I wouldn't trade on it, but I've got a feeling that something good is going to happen there in the UK. All right, let's look real quick. Let's switch to the TOS charts, and let's look at what I want to look at first. Let's look at oil. Now, as you know, this looks like an ABC, and this may be finishing out. This is starting to get pretty long here, so I don't know if this is a big sideways move. It could just be that it's going to come down to here and then rally out. But I would say anything around this $29 area, if you can pick up oil there, or really just anywhere below 35, if you can pick up oil, I think it's going to be the last chance you ever see oil below these levels here, like around $26. So, and if you've got a favorite oil stock, I think that's maybe something you should look at as well. I think what's going to happen here, it's largely going to be a currency event. Oil is sold in dollars all over the world, and as the dollar starts to roll over and go down, oil is going to just rocket to the upside. So if you buy oil stocks, you can get the dividends reinvested and things like that. All right, let's look at the euro. The euro is still going lower, but not by much. And I keep saying I think it's about over, and I'll say again this week I think it's about over. For one thing, there's not a lot of support below here until you get down to here, and I don't know. It's hard for me to see how the euro could go all the way to here before it rallies quite a bit. So my feeling is that we're very, very close to a buying opportunity. It's hard to tell what kind of pattern this is. This was an A, and then A, B, C? I don't know. There's a B in here maybe somewhere, and then this shallow C. I mean, so it's a strange looking pattern, but there's just a lot of congestion right here between 1.15 and 1.11, 1.10. And that's building a huge area of support. And I just think you got to look to enter somewhere in here on the euro if you're looking to hedge, the devaluation of the dollar. All right, let's look at gold. Gold's had a big rally. We drew this a while back, and it's it's either done or almost done with what we drew. Although I had it drawn a little higher, but it looks to me like it's running a little out of steam. I mean, it might shoot a little higher, maybe get up in here to the 1460 area. But I think this down up sequence has already happened. It's basically in here somewhere. So it might come down and then actually make a new high up here around 1460. But it's starting to get to the end. A lot of people don't realize how fast this moved out from here to here. I mean, it really rocketed out of there. And so essentially what you've got, is, A, B, C. Okay. So this is A. This whole thing is B, which is made up of A, B, C. And now we're going to get C down. This is one of the reasons I think oil is likely to go, down to that 25 area. Is that generally speaking, your commodities are just across the board are going to go down. What's interesting is I think they're going to go down about the same time the dollar is going to go down. But instead of what they'll do is they'll bottom at some point and then rally. But I think the dollar is just going to keep going down. So we just have a lot of debt, too much debt. Interest rates are too low. It's just a lot of manipulation with our currency, and I think there's just going to be hell to pay on that. So, but look, it's your money. You trade your money the way you see fit. I'm just trying to give you some large macro pictures here, and hopefully you find a way to exploit it. I mean, there's no reason to sit around and just stick your head in the sand. Might as well exploit it. So, all right. Let's see if there's anything else that I really want to. I think that's really it. I mean, just to recap real quick. I mean, we're at a place in the S&P 500 where risk has picked up, and we're back at very high levels. I mean, put call ratios are really high. In fact, let me see if I can't remember if the Elliott wave. No, I don't think they put in a put call. No, they didn't. But sometimes they put in put call ratios and investor sentiment and stuff like that. And you can see where they've got it drawn. They've basically got this complete or nearly complete. Now the Dow looks quite a bit different. It looks like maybe it could make a new recovery high. But the S&P looks pretty much done. It might just chop a little bit and then slowly kind of roll over and then really start to accelerate. Let's give you a picture of there's 30-year Treasury. So 30-year Treasury is not too different than the 10-year. We're talking about it making a new low here. which would lower raise yields. I mean, I'm sorry. This is the yield. So if this lowered, then the value of the bonds would go up one more time to eclipse this previous high or low if you're looking at yields. Here's the dollar. Again, the dollar, this is looking very ABC-ish. So I don't know, maybe this was the first move down from here. 1, 2, 3, 4, 5, and then this is ABC. I don't know. I'm not sure. It's very messy here. But it could very well be C. A, B, C is complete, and we had a 1, 2, 3, 4, 5 down. We got an ABC back up. If that's the case, we should see the dollar roll over next week sometime, begin that rollover process. And same thing with the euro. Although the euro made a new low, so and this doesn't look like. Let me just zoom in here. Well, I can't zoom in. Yeah, I can. Let me do it like this. This doesn't look as much like a five-wave move as it does on the dollar. For one thing, you get some overlap here. There's a little bit of overlap between this wave 4 down and this wave 1, which is not allowed in Elliott rules. But you can kind of see here that you kind of chop, and then again. If the problem is this made a new low. Now it could just be some inefficiencies or something, bad data, but because this made a new low, it cannot be a 2. So then that means this is not likely a 3. So I don't know. I'm watching it very carefully to see what happens at this juncture, but it's not a clean pattern. There's definitely some stuff wrong with it, and it's got me a little bit bumfuzzled, to be honest. So here they're saying gold, here's your B wave, A, B, C, right? Where this whole thing here is A, this whole thing here is B, and then we're going to have a C down, like I've been saying before, probably somewhere around 700. I don't know. We'll see. But generally speaking, commodities are going to go down for some reason and for some period of time. So, all right. I guess that is really it. I don't think I have anything else to say. And certainly if there's anything anybody out there listening wants to talk about or say, feel free to do that. I welcome comments. Got a comment the other day about, how we've been watching the treasury yields, and I appreciate that. Although, in retrospect, I think maybe there might be one more low, so I haven't been dead on accurate. But that's trading. I mean, trading is like that. You're not going to be right every time. In fact, you're going to be wrong a lot of the time. The key is to be wrong small, and when you're right, try to be right big, which is difficult too. I mean, here you are, you're making money, you're right, but all you want to do, all you can think about is, oh man, I need to sell some here so I don't look like a fool. But the reality is, in order to make money, you really need to let, the winners kind of go. And it's super hard to do. I mean, trading is not hard. It's simple, but it's not easy. And it's mostly not easy because of the person operating your computer, which is you. So, if you can get yourself out of the way, you can be a successful investor, a successful trader. But it takes a lot of practice, and it takes a lot of seeing the same things over and over again so you can begin to feel confident at what you see so that you're willing to put money at risk. But that's just what it is. So for those of you that are out there working at it, keep working at it. Be diligent. Write down things when you see them, and try to see things that
occur over and over. The reality is, I mean, I come in here and talk about this, but the reality is you have to invest and you have to trade what you see. You may not see the same thing I see, and it's impossible to really manage trades or investments if you don't see the same thing. So learn to see what you can see and then trade accordingly. All right, everybody. Thanks for coming in. We'll talk to you next week. Bye-bye.